My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be my friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate, to teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. You can't make up these moves. I'm talking about the big runs in all sorts of stocks going into earnings, runs that raise the stakes to dangerous levels for those who want to buy stocks before the companies report. And you can't see it in the averages where the Dow gained 273 points today. Dow edged up 0.27%, NASDAQ advanced 0.26%. But it's pulsing underneath virtually every major company I talked about in my game plan on Friday traded erratically high today. Let me explain. First, you need to understand that no one knows these earnings numbers ahead of time, except the CEO, the CFO, and a very small group of very important people in each company, and they are tight-lipped. The analysts often try to sound like they know, but we've seen how wrong they can be over and over and over again. So when a stock roars into earnings, it's not like it reflects inside information. It simply reflects excessive enthusiasm.
House of pleasure.
In other words, these stocks are going up on nothing. And that, I think, makes them very dangerous. That's what we got to talk about. Let me give you some salient examples. Tomorrow night, we hear from Alphabet, which is up nearly $20 from its September lows, including a buck and change again today. Alphabet's notorious for not delivering its most desirable set of numbers. There's always a revenue number that's a little off or an outsized loss in the other bets catch-all division or some figure that shows that they paid too much for too little traffic. This time the issue might be management is defensive about Gemini or their AI platform. Even when the quarter's genuinely good, Alphabet can make it sound bad. Oh, and maybe they reveal that Waymo's losing money hand over fist. We got a brand new CFO here. Maybe they want to tell things differently. Very hard for the stock to go up on earnings unless nearly everything goes right, and for this company, it rarely does. Then there's AMD. Now, I think this stock is dirt cheap. We buy it for the trust, but the company just bought ZT Systems for $4.9 billion in cash and stock in order to compete more aggressively with NVIDIA. AMD said it intends to break off ZT's data center infrastructure manufacturing business, the hardware component, and sell it. What happens if they don't sell it? What happens if they can't sell it? Will the stock get dinged? Clobbered? How about these new AI-fueled personal computers? Are they selling well? We hear no. Like all these stocks, there are a ton of variables, and no one knows the answers except CEO Lisa Su and a couple other people at AMD. But I do know that AMD's run up nearly $30 from September lows, advancing another $369 today, and that makes it more precarious. All right, how about McDonald's? When this stock fell from 316 to 292 last week on the E. coli outbreak, I thought it would be immunized from anything negative. But now it's creeping right back up, rallying $4 today on what? On what? That it's reintroducing the quarter pounder sans onions in some states? We don't want that pre-earnings rally. We want the stock to have no fluff so it can go up 5 on a good quarter. Now it's borrowed that upside gain. It'll go up, but I don't know how much anymore. Wednesday morning, classic. It starts with Caterpillar, which rather notoriously reports a headline number that's immediately traded upon before we get any of the small print from the company. You get the headline earnings and sales numbers, but they don't tell you everything you need to know. In fact, they're not even, in many cases, the most important thing to know. People will want to know about inventories. And if Cat's up big on sales and earnings, it can go down big on inventories, or in other words, where the big trucks are. So, sure, you're going to get some terrific verbiage about the data center. You need Cats to build that stuff, including their backup engine. Remember, by the way, I saw the Cat solar engine on the rig last week. I'm sorry, the platform last week. Now, I think Cat's doing amazingly well. They've been able to stop the chatter about lower sales in China. It means nothing now. But, man, this thing is already up more than $60, 6-0 from September lows, and attacked on nearly 5 points today. On what? I say it's run too much. And I like the company very much. Wednesday afternoon, it's Meta and Microsoft. Now, I think Meta's the cleanest one of all the stocks, okay? that's going to report this week that I've been talking about. Last quarter, Mark Zuckerberg laid out a strategy where his company becomes the most important place for a company to advertise, like these big consumer products, like the Colgates. In the future, you just wire money to Meta, and they design your campaign and place the ads where they should be and have to go with people who want them. Everything's targeted. Customers will save billions of dollars. But geez, Meta jumped nearly $5 today on nothing. Fortunately, at 578, it's still well below its all-time high of 602. I think it's the least problematic of the big names we're hearing about this week. As for Microsoft, well, maybe you caught a break in this one with the stock down $1.50 today after being up 4 at one point. Now, you need the discount. You need that discount. Why? Because we keep hearing that Microsoft's Copilot, much vaunted Copilot, I should say, has stalled. It's gotten some mixed reviews, including from Gartner, very important source of information. It's being knocked on Twitter by Mark Benioff, CEO of Salesforce. The long knives may be out for Microsoft. So if there's a dent in the sales, look out. We also have to worry about Azure, the web services division, which can upset people, even if it only misses by an infinitesimal amount that you and I can't see without a microscope. Microsoft is no longer the lock it used to be. Thursday could be dreadful, people. You know I say own Apple, don't trade it, right? But having the stock up $2 today, setting it within $4, spitting distance of its all-time high, that's a prelude to a nightmare. We've heard so many firms ahead of this quarter, and almost every single one is negative. They're going to miss, they're going to miss, they're going to miss, they're going to miss. Oh, and did I mention that they're going to miss? There aren't enough iPhone orders. China's terrible. Who cares about AI when you can't see it? Neither AT&T nor Verizon called it as doing well. They didn't say that. And T-Mobile said it was good. And the stock's so high. For some reason, the drumbeat of negative news about weak orders and lousy lead times hasn't impacted the share price this time. I say strap yourself to the Apple mast because it could get real choppy/ugly. Now this stock's got to be a perfect report, okay, to go up from these levels. And I think the word perfect does not come to mind when we're talking about Apple's quarter. All right, how about Amazon? Now, there's so much that could go wrong here. The last time Amazon reported, it missed its retail sales number, causing people to head to the exits all at once. The stock got plummeted all the way down to 161. Didn't help. Forecast was bad. Forecast is the forecast. It's now back to 188, yet there's no sign that retail's improving. And if you think back, they gave you a downbeat forecast because of the attempted assassination of Trump, as well as the Olympics. Now, you can never count Amazon out, but I do not love the risk reward here, even as we own the stock from a Chapel Trust. Then there's the problem of Project Kuiper. It's like Mel Kiper, or it's like that really weird green liquor. Amazon's money-losing satellite internet service is Kuiper. Elon Musk's allowed to lose whatever the hell he wants, right? I mean, he can do whatever he wants because SpaceX is private. But the same $2 trillion, he could lose $2 trillion. They make it up with a deficit. But the same rules do not apply with Amazon. I think Kuiper comes in a negative, not a positive way, and people are going to say, I didn't know. You read this piece on CNBC.com today, you'll know exactly what I'm talking about. Go there. But wait for the show then. Every one of these tech titans will be held up to scrutiny about their data center spending, and they'll be asked about the monetization of what they spend. Each one better have a good answer, certainly better than what Alphabet did say last time, saying it's necessary because the other guys are spending and you have to keep up with them, then their stock will be sunk. Even if it's a legitimate explanation, don't do that one. Every one of the tech titans will also be accused of writing too big a check to Jensen Huang at NVIDIA. They'll try to say that they're developing their own chips and they don't need Jensen Huang, but it won't be. Let's say it could be disingenuous. How about that? Look, I am indeed trying to discourage you from trading these stocks ahead of the quarters. It's just a roulette game based on nothing. Often the game feels rigged. You just don't know which way it's rigged. Because companies really and truly do not let this stuff drip out because it's like really bad to go to jail. Jail, bad. The spigot is closed. Bottom line, no one on Wall Street knows what any of the quarters will look like except for the principals. So don't bother to follow the money that you see trading right now in anticipation. You know why? It's a fool's errand. Chase in South Carolina. Chase.
Booyah, Jim. How you doing
Booyah.
today?
I'm good, Chase. How about you?
It's a great day in the state of South Carolina. I have a quick question about Honeywell, and I've been a long-time player in it and a holder in it. It's done very well, and would like to get your thoughts on its recent activity in the marketplace.
Well, The quarter was very poorly received. And you know why? Because it was a very poor quarter. I was not happy. I had this great grandmother, Nana Mary, and she always said to me, if you have nothing good to say, then don't say it. Nana Mary was always right, even about Honeywell. I'm trying to discourage you from trading this week's big cap stocks ahead of their quarters. It's a guessing game, and I don't recommend it. By the way, people did it on Honeywell. How you doing, partner? On Mad Money tonight, I'm checking up on HCA Healthcare to see if a pullback could be a sign to buy. Plus, you called in, you stumped me with the Sportradar group, so I did a little research, give you a rundown. And later, where does HPE, Hewlett Packard Enterprise, stand in the AI race? I'm getting the latest from its CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
What the heck went wrong at HCA Healthcare? Now, this is a company that runs a network of nearly 200 hospitals, plus hundreds of urgent care centers, freestanding surgery centers, and various other outpatient facilities. I have been a huge fan of HCA, recommending it repeatedly as part of the post-pandemic rebound in healthcare utilization. Basically, people who postponed non-urgent procedures during COVID built up a huge backlog, and they gradually been coming back to the hospital. Now, I recommended HCA in August at $376, and earlier this month made a new high, at all-time high at $417. But last Friday, when the company reported, it delivered a shocking top and bottom line miss, sending the stock down 9% in a single session. So what was the problem with the quarter? And more important, is HCA still worth owning? Honestly, not only is it worth owning, I think you're getting a fabulous opportunity to buy the stock at a great company on weakness. You got to do this. Sure, the headline numbers were legitimately weaker than expected, but not massively weaker. These guys earned $4.90 per share. Wall Street was looking for $4.96. Okay, on this, but not great. It's also not the end of the world. Revenue was light by about $53 million, which is barely more than a rounding error, considering they racked up roughly $17.5 billion in the quarter. More importantly, you need to ask yourself where these shortfalls come from beyond just the headlines, because some shortfalls are a lot more meaningful than others. In HCA's case, the entirety of their sales and earnings miss came from none other than Hurricane Helene. See, this hospital chain operates nationwide, but they've got a particularly large footprint in the Southeast, including a hospital in Asheville, North Carolina, which is in the part of the state that got hit hardest by Helene. Some people feel like it was ground zero. HCA also got hit by Hurricane Milton, which did a ton of damage in Florida earlier this month. By manager's estimates, the company incurred additional expenses and a lot of revenues estimated at $50 million or 15 cents per share, purely from Helene. Remember, HCA only missed the estimates by 6 cents. So without the hurricane, back up the hurricane, we would have been talking about a 9-cent earnings beat instead. Bye. Unfortunately, especially when you add in Milton, these hurricanes will likely hurt HCA's fourth quarter numbers too, perhaps much more than they hurt in the third quarter. So you have to deal with this again. Management estimates that the damage from the storms will have a $200 to $300 million impact during this quarter, meaning 60 to 90 cents per share. Hey, by the way, that estimate doesn't include any insurance recoveries that the company might receive, but it's a severe hit to the numbers and a major reason why the stock got poleaxed on Friday. However, this hurricane damage is a one-off thing. It's not like there's something wrong with the core business. They were victims of bad weather. Plus, HCA also had some very good things to say that didn't seem to get much attention at all. First, even with the impact of the hurricanes, management reaffirmed their previously issued full-year forecast, even though the storms mean the numbers will likely come in at the lower end of their guidance ranges. The only change to the forecast was a slightly lowered capital expenditures outlook. Now, Wall Street was looking for numbers to come in at the high end of HCA's full-year forecast. So when management says the actual results will be toward the lower end of these ranges, well, that is a technical disappointment. If you want to look at it that way, fine. But I think it's pretty impressive that HCA could get hit by a pair of severe hurricanes that will collectively cost them more than $250 million. Yet they'll still be able to hit their financial targets. At the same time, HCA issued an outlook for 2025, though it was light on specifics. I admit, I found it encouraging. Listen to this, quote, while the company anticipates some ongoing impact in 2025 from Hurricane Helene and its North Carolina facilities, the company believes these ongoing effects will be manageable and currently expects 2025 diluted earnings per share and adjusted EBITDA growth to be near or slightly above the upper end of the long-term growth range. Above! These long-term growth targets call for 4 to 6% EBITDA growth, 8 to 12% earnings growth. So next year's looking pretty good. Just as important, when you look past the impact of these hurricanes and check under the hood, there were some very strong positives here. Remember, the whole bull case for HCA is that people are seeking health care at higher levels than we've seen in recent years. That theme's still going strong as the company's same facility equivalent admissions, by the way, that's basically like a traffic for a restaurant, grew by 4.5%. Wall Street was only looking for 4.1%. That's a key metric for me. The other thing that got lost in the myopic focus on hurricane damage was HCA's continued progress on cutting costs. As I explained in August, healthcare providers of all stripes got hit with elevated costs during the pandemic, especially labor costs, as there was a huge shortage of medical workers. But now those costs are coming down, improving HCA's margins. In the quarter they just reported, the company's EBITDA margin improved by 90 basis points year over year. That was almost entirely driven by low labor costs, with labor costs as a percentage of revenues improving by 160 basis points year over year. That is fantastic. Meanwhile, there were broad volume growth across HCA's various different service lines. Pricing looked good, too, with revenue per equivalent admission growing 2.5%, another key metric. Overall, HCA's core business is still going strong, just like we've been seeing all year. Again, it really seems like the only meaningful problem this quarter was the impact of the hurricanes. Personally, I believe that bad weather is a bad reason to sell a hospital stock, bad reason to sell almost anything outside of the ag space. That's why I think you have to step in and buy this pullback in HCA. After taking a look at the results, the guidance, and the core trends within the quarter, I feel very comfortable saying that the business here is still very strong. Bottom line, I've been bullish in HCA for quite some time, thanks to the boom in healthcare utilization, and there was nothing in this quarter that made me feel like things have changed for the worse at all, even as the stock got obliterated. As I see it, that means the sell-off's giving you a terrific buying opportunity. Periodically, things like this happen. Plus, at the point in this quarter, Wall Street starts looking at next year to make investment decisions rather than valuing stocks based on what's going to happen in the fourth quarter. So forget about the impact from the hurricanes, which should be minimal as we move into 2025, and buy HCA, which is now trading at its lowest level since early August. All aboard! Mad Money is back after the break.
Coming up, is there an under-the-radar way to ride the rise of sports betting? Cramer's turning in his homework on the name. Next.
Every time you call in and ask about a stock that I either don't know or haven't looked at in a while, I put that name to the side, and I promise to come back with a more informed opinion after doing some homework. Last Monday, we're finally caught up. Last Monday, we got a call from Jake in New York. And this fellow wants to know about a company called Sportradar, SRAD for all you home gamers. He stopped me. I mean, just flat out stopped me. So I said to get back to him. This one's interesting. Sportradar is a Swiss company that offers a range of products and services to betting operators, sports leagues, and media companies. On the betting technology and solutions side of the business, which accounts for more than 80% of sales, they're catering to pretty much anyone that offers a sports book. DraftKings, FanDuel, regular casinos with sports betting. Sportradar gives them reliable, comprehensive sport data, as well as content from sporting events around the world. Now, they also have their own odds service, including both pre-match odds and live odds. Those are very hot. In fact, the live odds platform is the most popular in-play service on the market. They even have sophisticated trading risk and liability management solutions embedded in the platform. Think of Sportradar as a pick and shovels play for sports betting. That's kind of like the Gold Rush 8. Never mind. It sounds enticing to me. We know that sports betting has become a massive business, and all the players need this stuff to operate as efficiently as possible. On the other side, they got the smaller side of this business called sport content technology and services. Sportradar serves everybody from leagues to teams to media companies that broadcast sports content. Lots of marketing and media services that help with digital advertising. Video and analytics for coaches and scouts. That's pretty cool, huh? Tools to help sports leagues manage competition and produce official data. Finally, it doesn't not by hand anymore. Finally, Sportradar offers integrity services, which help sports organizations monitor for cheating. Even governments and law enforcement use this stuff. Now, this stock was a product of that IPO boom in 2021, but it came public toward the tail end of the period. Never really caught on initially. Sportradar came public September 21 at 27. Then the stock ran to an all-time high of 28 in its first week of trading. And then it started falling, ultimately sinking to single-digit status by mid-2022. In July of that year, it finally bottomed at $7 and change, but it stayed stuck in the single digit for a long time, which is why I never really paid any attention to it. I don't look at many of those. However, in the past year, wow, Sportradar has caught fire. It's up nearly 43% over the past 12 months, although much of that move came at the end of 2023. Just year to date, it's only gained about 13%, so it's good, but it's still lagging the S&P 500. Now that I'm giving you this company a fresh look, I've got to tell you that there are some things here I really like. Unlike so many other members of the IPO class of 2021, these guys actually make money. In fact, they've been profitable since coming public. More important, the trends for Sportradar, financial results, they look great. Using Sportradar's latest revenue and EBITDA guidance for 2024, both lines will have more or less doubled over the past 3 years. Put another way, Sportradar's revenue has increased at a 24% compound annual growth rate in these past 3 years, and its profitability has grown even faster. What's driving the strength? Okay, in the past few years, there have been several rounds of rights renewals, which have proved to be pretty expensive for Sportradar. See, the company has to bid for access to each of the leagues that it provides data for, and it has to negotiate with each league individually. The cost of these rights has risen substantially over the past few years, which has put a lid on Sportradar's earnings power for a long time. Now, though, there's just one big deal left, and that's with Major League Baseball. After they negotiate this one, Sportradar should have a period of calm where there's good visibility into its cost for a few years. That means they'll be able to focus on growing margins. It's why, when you look at the consensus estimate into 2025 and 2026, you see Wall Street expecting significant earnings growth. A couple of analysts have pointed to this dynamic in bullish notes on Sportradar. Back on September 4th, analysts at JMP Securities upgraded their stock to buy, basically arguing that as the company laps these expensive rights deals, the numbers should look a lot better. So kind of what we just described. Just 1 week ago, the same day that Jake called about this one, Sportradar caught an upgrade to buy overweight by analysts at JP Morgan. Hold it, wait a second, JP Morgan? After meeting with management, they said, quote, "We come away incrementally encouraged with SRAD's ability to leverage the sports data rights to innovate on product and generate pricing power that is garnering higher share of wallet, especially around live betting, creating a favorable setup for margin expansion as we come out of the most recent rights renewal cycle and into a multi-year period of what should be continued top-line momentum and lower operating expense growth," end quote. Again, same thing. Once we get through this MLB deal. Now, put it all together, and I think there's definitely something to this idea from Jake in New York. Sportradar's numbers, they've already been improving gradually in the 3 years since the company came public. But the business looks a heck of a lot more attractive now that they've almost done bidding for expensive sports leagues rights for quite a few years. That makes for a nice catalyst for the stock going forward. I think both JMP and JP Morgan are very right about this stock. How about valuation? All right, $3.7 billion market cap, just $277 million in earnings before interest, taxes, depreciation, and amortization, EBITDA expected in 2025. Stocks trading there for roughly at 12.3 times next year's EBITDA numbers when you back out their net cash position. Now, it doesn't seem particularly elevated, especially when you consider that Sportradar's got real earnings growth that should improve going forward. Although when you do a more traditional analysis, things sells for 48 times next year's earnings estimates, which is toward the high end of what anyone would pay for a company with mid-20s growth rate. I think it's the wrong metric because the earnings are still relatively small here and just entering a major growth phase. But I get if you have reservations, if you don't like using EBITDA as a valuation, it doesn't work for you. But I say go for it. If you're intrigued by the Sportradar story, that said, I still consider this as a speculative stock simply based on the nature of the business. Here's the bottom line. I'm not sure if I'd be willing to invest in Sportradar, but you've definitely got my blessing to place a bet on the stock. Hey, maybe you can parlay it with my existing favorites in the sports betting space, DraftKings could be a very considered investment, not just a gamble. Pal in New Jersey, my pal. Pal in New Jersey, pal.
Booyah, Jim. How are you?
I am doing fine. How about you?
I'm fantastic, and I wanted to wish you, your family, and your amazing team all the best for an amazing season. I've been a fan for a decade or more, so glad to be here.
Thank you. Yeah, you're very kind.
And also for the best-in-class sound effects.
Thank you.
My question was around NET, Cloudflare. You'd love to get your outlook as a potential AI.
Okay, I think Matthew Prince is doing a remarkable job. I think this company has more knowledge base than almost any company in its in video streaming. I like the company very, very much. I'm not put off by the high price earnings multiple. I think it's terrific. I say buy. Craig in Missouri. Craig.
Booyah, Jim. Great to talk to you. My question is over GoDaddy stock, GDDY.
Yeah.
I know they're reporting earnings later this week. I know that a lot of big investors are holding it right now. I see the stock price going down from 67 to 160. I'm wondering, would it be advisable to look at maybe buying before they report earnings, or just waiting until after? Because I've got a conviction that they might have some really good earnings, and sometimes when you buy a company that has really good earnings, that can be a big reward.
Well, you probably know more about it than I do. I have tend to hang back and not buy ahead of the quarter because I think that stocks do not necessarily in this year tell you which way they're going to go if you buy them ahead of the quarter. You do have an inkling. You have maybe some intuition about it. I do not. I personally would say let's see what the quarter is and then make the investment. But thank you for your kind words, and thank you to our first caller for the kind words. Now, if you're intrigued by the Sportradar story, I say go ahead and place a bet on it. I still consider speculative stock simply based on the nature of the business. Now, much more made money includes my exclusive with HPE. That's right, Hewlett-Packard Enterprise on the heels of its AI day earlier this month. Then, in this turbulent business cycle, I'm really one cyclical retailer that I think is actually built with some strong secular assets. We do a little teaching tonight about this, too. Don't miss my deep dive on a club name that I like so much. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. So many artificial intelligence stocks have roared this year, but not everything with an AI angle has gotten credit for it. Take Hewlett-Packard Enterprise. They're the maker of servers, storage, network equipment that was created when the old Hewlett-Packard broke itself up 9 years ago. See, HPE recently hosted this tremendous AI day where they laid out how the business will benefit from this breakthrough. Call me impressed. Naturally, we got a lot of questions, though, which is why we're going straight to the source with Antonio Neri. He's the president and CEO of Hewlett-Packard Enterprise. Mr. It is a delight to have you on Mad Money.
Thank you, Jim, for having me.
Now, I want to get straight to the issue, which is that if I were to call NVIDIA, I couldn't just say, NVIDIA, please install what you have, get Jensen Huang on. It doesn't work like that. Yeah. They have to go to someone who knows what they're doing, has expertise, and can make it work and service it. And that's you.
Absolutely. And we have a standing partnership with Jensen and his team for many, many years. In fact, we have built some of the most amazing supercomputers that today run many of the applications we speak today. But ultimately, you need someone who has expertise in system architecture, especially as we look into the future with liquid cooling and the need to scale and drive power consumption down and density up.
Right. Now, these things do burn hot. Everybody wants to use less electricity. Also, everybody recognizes that there are many environmental hazards for burning hot. You've got a solution. You mentioned it, liquid cooling. In your wonderful AI day, you explain why there are other forms of cooling, but they don't work as well, do they?
Yeah, well, remember, when you burn your finger, where you go? Normally, you don't blow. You just go to the water, right? So
one's air and one's liquid, and you're liquid.
Yeah, so what's today, how we are cooling the system today is a mix of both air cool and liquid cool. And there has some advantages, but when you think about reducing the power consumption by 90% from traditional air-cooled and reduce the space by 50%, which means we make the system more sustainable. We need to go to 100% direct liquid cooling. And so a couple of weeks ago, we hosted our AI Day, and HP announced the first ever 100% direct liquid cooling. And what you see here is not just the traditional server with a GPU that NVIDIA builds, which is amazing, but also the products like the networking switch. And remember, you need a lot of networking capability to stitch this vast amount of GPUs. So what you see here is the first liquid cool switching, which is our own intellectual property, which allows you to connect this vast amount of GPUs and also directly cool the networking aspect of the infrastructure.
Now, one thing people need to know is your Analyst Day, the AI Day, wasn't just about AI in terms of the fan versus liquid cool. You actually laid out the time to value proposition. And one of the things I loved was that you actually talked about how it's being used, customer support, legal compliance, contract reviews. You actually see that you've got actual use cases you see. Could you tell people why AI is not just something all made up to fool people?
Well, AI is going to transform our lives, and I think it's going to transform every enterprise. But you have to look at it from the lens of business productivity. And so some of the use cases you mentioned is how enterprises are driving business productivity through the transformation of the business processes using AI. So we see pharmaceutical companies using molecular docking to find new drug discoveries. When you think about, manufacturing companies like GE, for example, finding the most sustainable engine for airplanes, they're using AI to really do the simulation to a level we haven't seen before. But obviously, in financial services, they're all risk management. You think about marketing, using digital marketing AI to target the consumer in a much more predictive way. So there is tremendous amount of use cases, but there is also the sovereign space and then the service provider space.
Well, I was going to ask about sovereign. You spoke about sovereign many times. Now, that is something like Jensen was just in Europe last week.
Yep.
All it was about sovereign. People continue to think, unbeknownst to what they're really doing at NVIDIA, that everything is corporate, but it's the sovereign that has the most to lose if they fall behind.
Yeah. So I think, Jim, you need to think about the AI market in 4 unique segments. You have the model builders. These are the Anthropics, the OpenAIs. Right. We need tremendous infrastructure to train the model. And they train the model with the public data. Then you have the service provider, which are hosting this large infrastructure to serve sovereign or serve enterprise customers. But then you have the actual sovereign clouds, which are governments and academia building these large AI clouds so they can offer those services to both the private and the public side. And we see tremendous growth in that environment. HP is uniquely positioned because we have built for them the largest supercomputers ever built. In fact, HPE soon will own the number 1, number 2, and number 3 on the planet, and also the most sustainable supercomputers that you can run today.
When I read the analyst notes, I try to figure out, well, why the heck should you have such a low price earnings multiple? Your price earnings multiple, to me, is ridiculously low. Yeah, and so therefore the risk I regard as being low. But some people just say, Jim, you don't understand the execution risk of what they're trying to do when they're buying Juniper, a big company, means we have to wait and see. I've often found in my career that if I wait and see, then I miss the next 10 points. So can you reassure me, and I know it's not easy, but you have a large acquisition, that you're actually quite confident that it's going to work?
Yeah, so on the January 10th, we announced the acquisition of Juniper Networks. And we are on track to close that transaction end of this calendar year or beginning of calendar 2025. So it's just around the corner, I will say. But that acquisition provides shareholders an amazing thesis. Number one, through the synergies of the deal, we more than pay for the transaction. And we committed at least $450 million synergies. But then when you look at what they bring to the table, we actually, together, we can build the most modern, secure, AI-driven networking fabric, so we can give customers an alternative to the incumbency today. And that's from edge to cloud, meaning at the edge, bringing the AI through inferencing through the network and the compute capabilities HPE has, and then to the cloud to build these very large systems at scale, where networking is going to be one of the core tenets of the architecture. So between the high-performance silicon that they have and the high-performance silicon HPE has as well, because remember, on our HPE networking portfolio, we build our own silicon. In fact, they have a couple here.
Yeah, let's see.
So these are the networking switches that we build with our own silicon. These are Aruba networking silicon.
I remember you bought Aruba.
So we bought this company in 2015, and we have been building our own silicon since then. And so together we can offer customers a tremendous alternative, in addition to bring together the compute and the storage through the network.
Well, I've got to tell you, I look, sometimes you see a stock and you realize it's mispriced, and one of the reasons is because people, you had that legacy, the split. People never really got their arms around it. They thought Aruba, I don't know, you just showed me something Aruba. They're worried about Juniper. I always like Juniper. I think it makes you less compute-oriented, more AI-oriented, so therefore your price earnings multiple should go up. So, sir, I think that you've done some remarkable things, and I think it's a very, very compelling story.
Yeah, HP will play in 3 key domains, Jim. In the network, from edge to cloud, and to your point, it will pivot the portfolio financially to higher gross margin, higher growth. In the hybrid cloud with our HP GreenLake platform, we already have 37,000 customers on the platform, and that platform allows us to sell both cloud services and AI services, and then AI at scale with technologies innovations like this.
At a cost of operations that is radically lower than I thought. I want to thank Antonio Neri, the President and CEO of Hewlett Packard Enterprise. Thank you so much for being on Mad Money.
Thank you, Jim.
We'll be back after the break. It is time. It's time for the light round question. But the Raptor calls the same as the stock instead of buy, sells so. Just good to know the core stock side of the question. We plan to sell. And then the lightning round is over. Are you ready, Ski? Down to the light round question. Let's start with Tracy in Nevada. Tracy.
Hello, Professor Cramer. Third-time caller. I've been watching you since 2009. And you are the hero of my finances. I am blind, and my husband passed away in 2009. I'm also a widow. And at that time, my finances were very difficult. But watching you and taking your advice, you have helped me rebuild my finances to be very comfortable. And I am eternally grateful for you. You are amazing, and I thank you. And my question is about Lam Research.
Well, before I answer that, I just want to thank you. As is often the case, when you've been around as long as I do, you say, why am I still doing it? And the answer is, I'm doing it for Tracy. Because that's what I do for her. You're my boss, and I like working for you. And the answer about Lam Research is I like it very much here. LRCX should not have gone down today. I think it's doing extraordinarily well, and it's not just linked entirely with what ASML is. They already told you how much Chinese exposure they have, and they've had to cut it back. So the answer is I would buy it, Tracy, and thank you for your kind words. Let's go to Leon in Pennsylvania. Leon.
Good evening, Professor Cramer.
What's going on?
Suncor Energy. And,
well, you know what? There's another time when energy wasn't so bad that I would say Suncor 4% yield. Let's give it a shot. No shots are being given in this industry. I can't do that. We own Coterra for the Charitable Trust, and that's the only one that I countenance other than Chevron after spending a lot of good time, quality time with Mike Wirth on a platform in the Gulf of Mexico. He'd be the CEO. I want to go to Vikram, New Jersey. Vikram.
Hi, Jim. How you doing? Booyah. I love you. I love your show.
Well, thank you, man. Thank you.
Awesome. I wanted to take your opinion on Oklo.
Okay, Oklo is a short squeeze. Anyone, like right now, there's like another GameStop short squeeze. I get tired of this short squeeze. Here's my wrap on short squeezes. I learned early on that if you play them, they're like musical chairs. If you're cool with the music and you think you can anticipate when it ends, bingo, it's all for you. If you can't, then you're like me. I don't want to play. Let's go to David in Wisconsin. David.
Yes, how are you doing today, Jim?
I am doing well. How about you, David?
I'm doing quite well. I am interested in a company. It's an eVTOL company. That's electrical, vertical takeoff and landing aircraft. It's Joby Aviation.
Yeah.
Similar Joby.
Well, they just raised capital, and that capital is going to let them, they've got enough money to be able to last for some time. So I'm going to countenance buying it until they get until that money kind of runs out. I think they're okay for now because of the 40 million shares that they sold at 505, and that's not that far from here. But if it gets to 7, I would take the money and ka-ching, ka-ching. Let's go to Sam, Massachusetts. Sam.
Jim, listen, it's pretty unusual. You get a stock down 81% year to date, but that is exactly what the case is with Solar Edge Technology.
Well, Sam, I'm going to give you some positive news about solar edge technology. I've been in this business a long time, and I have learned one thing. Stocks stop at zero. Let's go to Jay in Oklahoma. Jay.
Booyah, Mr. Jim. Hey, man.
Whoa.
You are a rock star. Hey, question is on QS. They recently sent out their latest solid-state technology battery to their customers for testing. Have you heard anything about that? And
no. I mean, QuantumScape, the guys who told me to buy QuantumScape, they were quantum wrong. So I don't want to be quantum wrong. I want to be quantum right. I would avoid QuantumScape. Quantum escape, so to speak. How about we go to Don in Kansas? Don.
Yes, Jim Cramer.
Yeah, Don.
My question is about Net Apps. November Tango Alpha Papa.
That's a good company. They're making a lot of money. It's not expensive. I'm all in. We saw them in San Jose. We were having really good food outside in Mexican bar. I saw it. I said, I'm going to look into this. It turned out to be very cheap. And by the way, the bar had unbelievable mezcal. I mean, every kind, except for my wife's. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
When you're looking for stocks to buy, you have to make a determination right up front. Do you have a cyclical or secular story going for you? What makes that so important? Who cares? Well, the big money managers care. They want to get the timing right. And to do that, you need to know where we are in the business cycle and what it means for different industries. Right now, we have a bunch of companies that are trying to ride the business cycle, and they're failing to do so. They blame stubbornly high interest rates or the shambles of an upcoming election or inflation that refuses to be brought to heel. Oh, they're filled with excuses. The real issue, though, is that these companies are cyclical. They depend on the economy picking up when interest rates go down. If it doesn't pick up quickly enough, then it's hard for them to make the numbers. It's the nature of the beast. That's why we care about this distinction between cyclical companies that are hostage to the economy and secular ones that can put up similar results regardless of where we are in the business cycle. That's what we're looking for. Periodically, though, you find a company can straddle both the cyclical and the secular worlds, and when you find them, well, then you got to treasure them. Think Home Depot, which since going public in September of 1981 is up more than 1,000,000%. It's a tremendous accomplishment that the company has not only survived in such a tough industry, but it's even become the dominant national player. The despot pulled it off because it's been both a cyclical story and a secular growth story. There's a boom and bust portion of the business, but for most of that period since 1981, it kept growing regardless. In fact, this morning, TD Cowen explained why Home Depot is a lot less hostage to the Fed than you might think because of the partially secular nature of the company. Right now, it has four secular trends going for it. First, the aging housing stock, as there haven't been a lot of new homes built, and the ones that are around, they're in need of repairs. Second, it's got favorable demographics, which I take to mean that there are a lot of millennials who want to own their own homes, and if they can get one, they'll spend money on it at Home Depot. Third, the housing shortage is driving higher prices for homes, which plays right into the despot's hands because they do so much business with professional contractors. And boy, the way they've upped the ante with this SRS acquisition. Finally, fourth, there's plenty of home equity money sloshing around to redevelop and renovate. Cowen says these trends are very underappreciated. I agree with them. I come back and say, but ultimately it doesn't matter. When a company makes its numbers in lean times, the bad part of the cycle, that speaks loudly, and investors are listening. Now, you could argue that this is an unusual moment, but historically it's actually not that unusual for Home Depot. Their hybrid model works. The company's secular characteristics carry it through the cyclical pain, so even if the Fed doesn't move with alacrity to cut rates, Home Depot will still prosper. Or to put it the way they do, when your house is appreciating in value like they've been for the last couple of years, right, because of the housing shortage, then renovations are not an expense. You regard them as capital investments, which means you spend more than you might have expected. That's the essence of what Home Depot thrives on. On the other hand, if the Fed cuts rates more aggressively and the economy turns around, few companies will do better than Home Depot. Either way, it can win, which is why we own it for the charitable trust. I like to say there's always a bull market somewhere. I promise I'll run it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.